Good morning. Welcome, welcome. Good morning. I'm pretty sure you can hear me. If you can hear me, give me a thumbs up and I will remove myself. Good morning. Welcome to today's edition of Frugal Feeds. Quite excited about what we're talking about today. So just bear with me to get started. I'm gonna do the usual. Welcome, welcome. So I'm just going to take a moment and share. Welcome. We're going to be starting very soon. Welcome, Washington Don. Thank you for joining today. I just want to make sure that you can hear me and the guys on YouTube are able to join as well. So bear with me. If you can share, please share. Yes, so I think it's all good. We're now on YouTube. For people who don't have Facebook, you can always share the YouTube app with them, or the YouTube link with them. All right. So let's get a few things started. Welcome, welcome. Good morning. Okay, I think we're good to go. All right, so in approximately 1 minute, I'm going to start. So thank you for joining. Please share. That way we can have other people join as well. I'm going to be doing something extremely new today, so bear with me. Hopefully technology will cooperate with all of us today. I'm going to have quite a few things to talk about. So if you just want to grab something to write with, we can come back to questions a little later in the day or a little later in the session. So, okay. All right, I'm going to do a few things then. Good to go. All right. Okay, so today we're going to be talking about the stock market. I started this session about 3 weeks ago. I took a break last week. We took a break last week, so this week we're going to be doing a continuation of what we started. But before I start, I want to just introduce myself again to you all. My name is Phoebe with the Frugal Feeds platform. If you're not new to this platform, you already know what I do. I work in investment, portfolio management. I absolutely love the industry. There's so much going on right now. So it's very timely that we're talking about this. And again, just to recap a few things I've always said before, to build wealth, there's no way you can build wealth, sustainable wealth, without having some form of stock market without going into the stock market, for lack of a better word. We hear about passive income, dividend income, etc. The stock market is one of those places where you can realize passive income, dividend income, and the like. So just to recap, the last time we talked about the stock market, I did a general overview, of what it is, what a stock is, what an exchange is. So that's what I did the few times we talked about it. So today I'm going to be specifically focusing on analyzing a stock. What does it mean? What does it look like? What you should be paying attention to? I'm going to do that. And I did get the ability to share my screen with you. So I'm pretty excited about that. I just want to take a moment. There's been a lot of background behind the scenes running around, so I'm quite happy for that. So, okay, so going back to a review, just a short review of what we did. What is a stock? A stock is basically a small share ownership in a company, a corporation. So if you own one share of, say, Nike, you technically own Nike, right? You're a shareholder. So a stock is just a small percentage or a small share of ownership of a company. Now, we talked about the stock market exchanges, which is where you stocks trade. The people who want to buy, the people who want to sell, their orders go through an exchange and it is executed in that way. Nowadays, it's pretty instantaneous. It's pretty quick with technology. You can sit behind your computer in your home, wherever you are in the world, and still you're able to trade. So we did cover that. We talked about the New York Stock Exchange, the London Stock Exchanges. We talked about the correlation between the stock market and the economy. Now, if you didn't watch it, if you didn't follow the last time we talked about it, please do, because that way it would help you make sense of what I'm talking about today. So I want to pause there a little bit. Okay. So I talked about a brokerage firm opening an account. Before I go into stock analysis very quickly, in order for you to trade stocks, you do need a brokerage account, right? Or you do need an account with some type of discount broker, or there are many apps out there nowadays. They're not necessarily discount brokers, but they're doing the same thing. They're giving you the ability to buy stock, sell stock, etc. Now, when we talk about a stock, we talk about the stock market. It is huge. I find that a lot of people are very inundated with the amount of information that's out there. And I think one of the largest barriers to entry, especially within the stock market, is a fear. It's a fear and lack of information. People feel that, oh, how am I gonna, what do I know to buy? How do I get in? When do I know to get out? There's a fear of losing money. There's a fear of because of a lack of knowledge or education. I am trying to break those boundaries. I'm trying to break those walls of fear. That way you feel that much more comfortable to put your money to work in the stock market. Okay. So I'm just going to pause here for a second. Please, if you haven't shared, do well to share. If you haven't liked, please do well to like. If you can hear me just fine and you're tracking with me, give me a thumbs up in the comment section. If you can hear me just fine and you're tracking perfectly, give me a thumbs up in the comment section. If you need a little recap, go back on the videos that we have talked about before. That should help you a great deal. Another thing I wanted to make note of is a disclaimer, and I'm going to continually keep saying this disclaimer. All of this is for educational purposes only. So everything I say, every company I call, it is only for educational purposes only. It isn't a recommendation to you as an individual. I am not familiar with your situation. I am not familiar with your level of skill or knowledge, so I cannot give you advice without talking to you one-on-one. So please pay attention. Even if I talk about brokerage accounts or brokerage companies, it isn't an endorsement. It isn't a direct recommendation to you. It is only for educational purposes. So let me get that out of the way. That way you don't come for me. Okay. So when we start talking about a stock, right? Last time I talked about a stock, we talked about the different things that come into play. We talked about fundamental information. We talked about, fundamental analysis. We talked about technical analysis. So today, I'm going to take us mostly through fundamental analysis. A lot of what I'm going to talk about will be high level macro, microeconomy kind of things that we need to look out for when analyzing a stock. Maybe in the next few sessions, I'm going to get more in depth with technical analysis. Now, I am not going to go too in depth with technical analysis because it does take time. Now, if you do need more information on one-on-one tutoring, you can always sign up for a personal session with me, a private session with me, and I can walk you through that one-on-one. So the next few times we're going to be, I'm going to be coming back to you again. We'll be talking about technical analysis, but today we're going to focus on the fundamentals and what makes a stock a stock. Okay, thank you for joining, Usman. You said you love this video, you're into day trading. More power to you. All my day traders out there, more power to you. I don't have the time or the energy to day trade. It's all power to you. Thank you for joining, Cynthia, and thank you all for sharing. And everybody else, there are more people. I'm not able to see you. I apologize. In order for me to see you, please leave a comment, a hello, how are you, something, so I can give you a shout out as well. But thank you for joining, and please share if you haven't yet. Okay, so when we talk about fundamental information, right, what am I talking about? I'm talking about like high level macroeconomic things you need to be looking out for. Now, just to recap, fundamental analysis is looking at soft information. By soft information, I'm talking about you're looking at the earnings of the company, you're looking at the price earnings, you're looking at the leadership of the company. I have a whole list here. Yeah, you're looking at the revenue. Basically, you're looking at what the company is doing on a day-to-day basis. You're looking at how well known and how popular the brand is, because the brand also is a means of it's an asset. Depending on how well known your brand is, it becomes an asset to the company. However, it's not necessarily a monetary asset in the near term, but long term, it can become a very, very huge asset. For example, when you think about the brand like Nike, you think about Apple, okay, just its brand alone, without selling any products, just the brand alone is worth something. So when we talk about fundamentals, we're talking about those soft information, things that you can easily listen to the news, you can easily grab just by looking at the company or researching high level about the company. Now, that's really fundamental analysis. When we talk about technical analysis, we're talking about charts, we're talking about reading. Thank you for joining, Monique. We're talking about charts. We're talking about looking at the different ways you can analyze the charts. All of that. That's what a technical analysis is. A lot of day traders use in fact, day traders mostly focus on technical analysis of a particular stock. But we're not going to be talking about technical analysis today. We're going to be focusing more on the fundamentals. All right, if I keep looking, I'm grabbing my book, so bear with me. I'm doing a few things today, showing you one screen working from another screen, so bear with me. Okay, so fundamental analysis. Let me just get myself situated here. So when you think about a stock, right, when you want to decide, okay, where do I start? There's so many things. It's a big market. People get inundated with the amount of information that's out there. So I'm just going to give you a pretty plain vanilla, simple way to analyze a stock. If you want to start, where do you start? So you think about the stock market, right? There are 5,000 or so stocks in companies within the stock markets, the U.S. stock market, stock exchanges, and the stock market. That's a lot of companies to be analyzing. That's a lot of companies to be analyzing, and a lot of information, especially for a new investor to be absorbing. So you want to keep it simple. You want to think about it this way, okay? What type of investor are you? Are you investing for value, or are you investing for growth? Are you investing for value? Are you investing for growth? A lot of times, the people that I see investing for value are the age range is a little older. So you have people who are very passive in that, people who want the dividend income value. Really, we're talking about companies that are solid. They're very established, and they're very good with their dividends. So you can have a company A that maybe the stock doesn't appreciate a lot or very quickly, but then that particular sorry, let me turn off something here. Okay, so the stock doesn't appreciate a lot, but that particular company is really great at paying dividends. Okay, when you have that and you focus on companies like that, you tend to be more of a value investor. Okay, you tend to be more of a value investor. Now, if you're wanting to foray into the new age technologies, especially the tech companies that are the capital appreciation, or I'm sorry, not the value of the stock. That's what I'm trying to say. The value of the stock appreciates almost overnight. Look at Tesla, for example. Look at Apple, Amazon, all these groundbreaking companies that disrupted the market. A lot of these growth companies don't necessarily pay out dividends, but they do. You can stand to win big when you invest in them if you pick the right one, just because they're while they're not paying out dividends, they're putting all their earnings back into the running of their businesses, which accelerates growth. All things being equal, it accelerates growth a huge deal. If you've been tracking a lot of these tech stocks starting right from the early 2000s or early mid 2000s, if you look at their charts from when they first became public to now, it is astronomical the amount of appreciation that they've experienced, the amount of growth they've experienced. So you have to ask yourself, am I a value investor or am I a growth investor? You don't have to be one or the other. You can be a little bit of both. Depending on your age, for example, for me, I'm more of a growth investor. I have a long time till maybe retirement, right? Or I don't mind taking the risk. My risk level, my tolerance level is quite high. So I don't mind taking that risk and investing in growth companies. Now, there's some people who don't want to take the risk, right? The stick with the value, the things that they know that come what may, I will get some form of dividends from it. And dividends can pay out nicely. If you have a portfolio worth about, let's just say that the portfolio is worth about 100,000 and you're investing in a lot of dividend paying stocks, you'd be shocked or surprised to know that your portfolio by itself, without you taking a lot of risk, you can generate a cash flow of maybe in the tens of thousands, depending on what you're investing in. Again, depending on what you're investing in. So dividends can be somewhat of a good way to get extra income on top of the stocks that are being invested. Okay, I'll let that rest. So when you think about what type of investor are you have to think about why you're investing. Are you investing for the long term? Are you investing for the short term? Are you investing for your child's education? Are you investing for retirement? All these things would determine the kind of stock you buy, and all these things would determine how you analyze a stock. Okay, so the purpose of stock analysis, basically, long story short, whether you're a fundamental investor or a technical investor, the purpose of both fundamental and technical is to find an arbitrage opportunity. Okay, it's to basically, you're trying to get ahead of the market and see where you can buy a stock when it's undervalued, and then sell it when it becomes overvalued, right? If you buy low, you sell high. That's the idea of the stock market. There's another idea that if you buy it high, you want to sell it higher. If you buy it high, you want to sell it higher. So essentially, no matter what you do, even if you buy high and sell higher, whatever it is you decide to do, you would one way or another, you're still buying low and selling high. No matter what you do, you want to pay attention to buying low and selling high. All right, sorry, I'm getting a little carried away here. So after figuring out what type of investor you are, after figuring out your time frame, that will also determine the risk. Also figure out the kind of risk level you're willing to take. If you're willing to absorb a lot of risk, then that would also determine the things you buy, the things you invest in. So bear with me 1 second, sorry. Okay, so that's going to determine the things you buy and the things you invest in. Okay, so depending, if you're a long-term trader, okay, I tend to look at the market from a long-term perspective. I wouldn't say I am a short-term trader. I am definitely not a day trader, okay? Depending on your stance with trading, you can, how do I say this? Over time, it's been research has proven that the people who are long-term traders sustainably build wealth. Okay, so long-term traders, over time, you see an appreciation in the assets that you're holding. For short-term traders who are in the market to make a quick money in and out, etc. Over time, research has proven, unless you're a unicorn, research has proven that you lose more or you don't gain as much as long-term traders. So when I talk from a more long-term perspective. So that's just the word on long term and short term. Short term, I'm talking about anywhere from 24 hours to 1 year. Long term, I'm talking about anything over 1 year all the way up. Well, short term, 1 to 3 years or so. Long term, anywhere from there to 10, 20 years. As a trader. Okay, so when you've analyzed all of that and you figured all of that out for yourself, I'm going to pause here for a second. If you have any questions, if I'm losing you, please comment. If I'm not losing you and you're tracking okay with me, thumbs up. I need to see some thumbs up. That way I know that I am not losing people. That's not my goal. Okay, so once you've analyzed all of that, okay, what you want to do now is you have the ability to do a bottoms up approach. Okay, with investing, you have the ability to do a top down approach or a bottoms up approach. Now, what is a bottom up? What is a top down? Okay, sounds like I'm talking about making a drink, but it's really not. So a top down approach basically is this. Oh, well, I'm going to explain it, a bottoms up approach, and then focus more on top down approach. Thank you, Cynthia. Thank you all for commenting. Thank you, Grace, for commenting. Thank you for tracking. Share if you haven't, please. Okay, so a bottoms up approach is basically this. You're focusing on a specific company. Think about it like you're building a house, right? When you're building a house, you lay the foundation. When you lay the foundation, now you add more bricks and then you put the roof and everything. That's what a bottom-up approach is. A top-down approach is like putting the roof of the house and then putting the walls and then laying the foundation. Okay, for the purposes of trading, that is not a bad idea. For the purposes of building, that's a terrible idea, to put the roof and then start laying the foundation. But for the purposes of trading, having the roof first and then you add the walls and then you add the foundation is not necessarily a bad idea, and neither is laying a foundation first and then setting up the walls. It isn't a bad idea either. Again, it's just very subjective on the type of person you are and the type of trader you are. So just take note of that. Okay, so a top-down approach, I explained it. A bottoms-up approach, I explained it. Now, in financial terms, what does that mean? A bottoms-up approach, you're focusing on one company or just a few companies. Well, really one. you're focusing on a singular company. You're looking at their financials. You're looking at I have a whole list here. Yeah. So you're focusing on their financials. You're looking at their price equity ratio. I'm sorry, price earnings ratio. You're looking at their earnings growth. You're looking at their revenue, sales, all of that. Your balance sheet. That's why you're looking at the income statements. Okay. So you start out looking at that when you're doing a bottoms up approach. When you look at all those company specific things, then you start looking at, okay, the sector. How is that company performing within the sector it's in? Okay. Now, when you look at that, now you start building and putting the roof and thinking, okay, that sector, how is that sector performing in the wider macroeconomic sphere of things? Okay, so that is bottoms up approach. Now, top down approach is this. A top down approach is this. You look at the macroeconomic influences that abound within that environment. So you look at interest rates, you look at geopolitical issues, what's happening, you look at economic growth, GDP, you look at monetary policy, are the Feds increasing or lowering interest rates, you look at inflation and the price of commodities. Okay, so oil, gold, all of that. So from a top-down approach, you look at the big picture. Think big picture. So you can look at a geopolitical area, the Eurozone. You can look at the Eurozone. You can look at Asia. You can look at Southeast Asia. You can look at the African area. All of this that you can look at North America, etc. So you can start with that, okay? And within that environment, I'm going to use the Eurozone, for example. You think to yourself, okay, the Eurozone is made up of however many countries. Within that Eurozone, what are some of the difficulties you're currently facing? What are some of the areas that they're doing really well in, okay? Now, if there's political instability, right? If there are things that are disrupting business, okay, you think to yourself, okay, if these things abound within this geopolitical area, within this economic area, what are some of the companies or sectors that are doing well right now? Then you start looking at those sectors, and then you start breaking it down some more. Within these sectors, what are some companies that are performing well? A point to note is this: even though a particular sector may be doing well as a whole, okay, a sector may have, say a sector has 100 different companies or more than that. Okay, it doesn't necessarily mean that all those companies are going to do well, okay, at the same time. You may still have, depending on how the companies are being run and managed, you will have some companies that do well, and you would have some companies that don't do well. So you want to take note of that. Okay, so you break it down sector-wise. You think about the sector, you break it further. You think about the companies, you break it further to see which one is more advisable. Now, that is a top-down approach. I personally, as an individual, I am unapologetically a top-down person, meaning that I look at the wider prevailing economic circumstances. I look at what's happening with GDP, what's happening in the economy, what are the things that I need to be cognizant of before deciding now what sectors are performing well and which sector do I need to buy, which company within the sector do I need to invest in. I'm going to give you a short example. For example, if you think about bank stocks, if you think about your financial stocks like Bank of America, Barclays, Chase Bank, all these JP Morgan, all these big banks, okay? When you think about them, or any credit union for that matter, when interest rates are going high, okay, it is more revenue. When interest rates increase, it means that banks can generally lend out money and charge you as a customer a higher interest rate, okay? What does that mean for them? It means that if they're charging you and me a higher interest rate, that becomes more revenue for them. They're making more money in an increasing interest rate environment because they're able to assess more interest on loans, etc., that are being taken out with them. Okay, so in that environment, financials tend to do great. So if you're looking at a sector, financials is a sector. In that particular environment, financials tend to do well. So as an investor, you think to yourself, okay, interest rates are increasing or interest rates are high. Let me look at a few financial companies. Okay. Also, as an investor, if you are more opportunistic, okay, and you're looking for more growth, okay, when interest rates are quite low, bank stocks are not doing as well, you can decide at that time to buy banking stocks, okay. However, tread carefully because you don't know where the bottom will, you don't know if the stock is going to drop a little bit more depending on the environment we find ourselves in. But if you're an opportunistic investor, you're looking for an arbitrage opportunity, you can decide to buy bank stocks at that time. Now, when the economy starts doing better, we start having a better outlook for the economy, you would start see and interest rates start going back up, you would see these holdings, all things being equal, you would see these bank stocks start to appreciate in value. And when there's a stock, when you buy a stock for a certain amount and it appreciates to a certain amount, that middle section, the difference between what you bought it and what it sells or what it's trading at now, it's your gain. That becomes your gain. If you bought it quite high and it's trading quite low, the difference between that becomes your loss. So you just want to keep track of it. It becomes your loss if you sell it, and it becomes your gain also if you sell it. So you just want to keep track of that. Okay. So I talked about financial companies from a fundamental perspective. Home builder, if you're a home builder, a property manager, whatever have you, or a real estate agent, when the interest rates go low, when interest rates are lowered like we see they are right now, what happens? You see a lot of people are buying homes. Okay, home builders tend to do well. Companies that provide real estate, that sell real estate, tend to do well. Why? Because you have a lot more people buying when interest rates are low, which is why right now, with the prevailing interest rate environment, if you're in the market to buy a house, now is a good time. It's a good time to start having that conversation. The very first session I did was on credit repair. I did that for a reason. That way you can go back and start fixing your credit. That way, when it comes to buying a house, when you're ready, when you have the cash in hand and you're approved for financing, you can easily get a home at a very cost effective interest rate. So if you're a home builder, okay, people are going to be buying a lot of homes when interest rates are low. Now, if you're a company that you use oil, commodity, gold, all of that, or if you work for a company that, for example, an oil producing company, or a company that involves partakes in exploration, fracking, and all of that, when oil prices, sorry, let me think. When oil price, I'm getting a lot of things to talk about. When oil prices increase, when oil prices go up, guess what? Your company tends to do well, okay? Because you're essentially selling a barrel of oil for a lot more. Okay, so you tend to do well, all things being equal, as an oil company. So as oil prices are increasing, you think about your stocks like ExxonMobil, you think about Toyota, you think about Chevron, you think about Valero, you think about any other oil, you think about Halliburton. Yes, I think companies like that deal with oil. You think about all those companies. To invest in. Another note on that is this: right now we're in an environment where oil is terrible. Oil stocks, oil companies are doing so badly in the moment because the price of oil has dropped so much. So if you're again an opportunistic investor and you have a long-term outlook, okay, and you don't need money in the short term and you can absorb the risk, oil right now is very, very undervalued. I'm going to use that word. Oil is very undervalued. However, there's you have to pay close attention to the companies that you're investing in. You want to keep it high level. You want to keep it highly rated. You want to keep it. You want to go into companies that are that are great companies, are well-known companies. Now is not the time to be exploring and investing in companies that are little known, especially if you're a new investor, especially if you're just getting used to all of this. So that's something that you want to keep track of. So oil, financials, are a lot, industrials, they're great sectors right now to be looking at if you're looking for quote unquote stocks that you can buy at a very cost effective price. So that's something to focus on. So I used all these examples to just kind of tell you another thing to mention about oil is this, and geopolitical issues and oil. For example, one of the reasons why we saw such a drop in oil almost overnight was because of geopolitical issues in the Middle East, and with Saudi Arabia and Russia. So you want to be sure that if you're an investor, the least you need to do, the least thing you can do is just watch the news, pay attention to the news, read the front page of the news, see what's happening out there in the world. And it's not only going to help you as far as investing in stocks are concerned, it's also going to help you as far as making the proper choices, making the proper decisions, and when to make them. So that's just something that you want to keep track of, and you want to track properly. Okay, so I talked about the top-down approach. I talked about the bottoms-up approach. Let me see if there's anything I'm missing. The bottoms up approach, I'm not going to be focusing on more today. I'm going to be focusing on a little later when I start going into hands-on thing, like how do you calculate a price earnings, the price earnings ratio. 1 second. I'm going to be talking about a little bit more, and I want to talk about the price to earnings ratio, or the revenue, sales, income statement, all of that, and how to analyze it. The biggest thing and the biggest takeaway that you should know is this. When you're investing as an investor, apart from knowing your long-term goals, apart from knowing your time frame, etc., is you want to be, to a certain degree, well educated on the stock market. Okay, you don't need to know everything, but you need to become familiar with what to look at. When you pull up a stock, okay, what are you looking at? You have to know what that is. So I'm going to shift gears a little bit to show you to demo something for you. That way you know what you're looking at. And after that, that's going to be it for today. I'm trying to keep these sessions a little short, that way it's not overwhelming. So let me shift gears a little bit, and in the meantime, share the video, invite your friends. If you haven't subscribed yet, subscribe to Facebook. We're now on YouTube. Subscribe to our Facebook feed, YouTube, and Instagram feed under Frugal Feeds. So do all to subscribe. So let me do something right now. So I'm gonna shift gears a little bit and show you. So I'm just going to use Yahoo Finance. I tend to use Yahoo Finance sometimes if I want to quickly just take a quick look and see what's happening out there. There is also Google Finance. I find that Google Finance is a little easier to read just because it's a cleaner slate. It gives you all the information you need to know almost on one page, on one screen, where you don't have to be clicking left and right to find it. So you can use Yahoo Finance for just to research a stock. You can use Google Finance. You could use, there are many other apps out there and companies out there that you can use. As an investor, as a new investor, you may not know everything there is to know about a stock. I personally if you want to sit down and start doing technicals and analyzing all of that, it tends to be very time consuming, extremely time consuming. So one thing I find that a lot of investors have is the time. Retail investors don't necessarily have that time to sit down and analyze everything like professional investors do. So what do you do as a retail investor? There's so many analyst recommendations out there, from Morningstar to Credit Suisse to in fact, let me just, what am I saying? I'm going to show you what I do. I don't want to just talk. So let me do this. I'm going to share my screen with you. Okay, you can see that. Let me know if you can read what's on the screen. Let me know if you can read what's on the screen. If you can't, I'm just going to make it bigger. If you can't read what's on the screen, comment so I can make it a little bigger for you. Okay, if you can see all that on the screen, give me a thumbs up, comment good, and I can proceed. All right, so when we're looking at, this is just Yahoo Finance, and pardon all the ads. Let me just close this. That way it's not in our way. Okay, perfect, can read. Okay, so this is Yahoo Finance, okay? This is what it looks like, the landing page. Automatically, when you go to finance.yahoo.com, you see here, the last time we talked about, let me just remove my face, that way it's even bigger for you. Okay, perfect. So the last time we talked about this, right? With the stocks and whatnot, we talked about the different indices. So we have, that's the S&P 500, that's the Dow 30, the NASDAQ, and the Russell. So we see that as of yesterday, the S&P was up. So when you hear the news and people say, oh, it was up, it was down, this is what they mean. The S&P was up 9.16 points. The Dow was down 62.76 points, and you see the rest. And that's how, that tells you what the market did in any particular day. And this, of course, updates every single day as the market is trading. So now, you guys give me some ideas. Give me some ideas. What are some of the stocks that you want me to look into for you? Post them down and we're going to research them. But for now, I'm going to pull up, so Tesla. Is Tesla a good one? Yes, I'm going to pull up Tesla just because a lot of people have been going crazy about the stock, and I'm going to show you why it's been such a huge deal. Now, I really wish, let me try Google Finance as well. Okay. So I apologize. Let's try something else. Let us try something else. Okay, let me try this. Okay, that's better. That way I can, that's better. Okay, perfect. That way I can go between tabs and you see what I'm doing. So let's try Google Finance, TSLA, Nvidia, okay, American Airlines, plug, perfect, okay. All right, so Tesla, this is a perfect one. How do I expand this? How do I expand this? Okay, I can't pop it out. So we're gonna look at this. So when I look at a stock, right, you see here, I'm gonna back up to here because this is a better picture. So when you look at a stock, it gives you automatically the previous close. Okay, this is very basic information. It gives you previous close. It gives you what the stock, when the market opened, say on Friday, what did this stock open at? This is what it opened at. It opened at $1,513. So when the market closed, what was the bid and ask? Okay, the bid is what you sell. the stock at, the ask is what you buy. So remember, you sell at the bid, you sell at the bid price, and you buy at the ask. Okay. So if you want to know how much you can buy a stock in the moment, you look at the ask. If you want to know how much you can sell a stock in the moment, you look at the bid. Now, this bid and the ask changes depending on what the market's doing, depending on any other traders that are out there available to buy your particular share. So you buy at the bid, you buy at the ask. Remember, buy, ask, sell, bid. Okay, now I look at the day range as well. So it gives me an idea what the stock traded at within the day. So I know that, okay, the lowest point I could have gotten this stock is at 1490. Now, the highest point I could have gotten this stock is at 1537. Okay, normally you want to buy high, you want to buy low and sell high. So if I bought this at 1490 and I sold it at 1537, I would make a little bit of a profit there. But you want to, that gives you a good idea. Okay, now the 52-week range is a big one as well. It lets you know in the last 1 year, okay, 1 year to date, in the last 1 year to date, what has the stock been trading at? So the lowest it ever traded was $211 within the last 52 weeks. So if you were an investor and bought Tesla at $212, guess what? Right now you'd be at 1794. That's a huge gain right there. I don't know about you, but the goal when it comes to investing is you want to buy quite low and sell quite high. Not a lot of people have that touch. Again, remember what I told you about trading long term. Imagine if you bought this, okay, and I'm going to do a demo here, for example. So the last 1 year, right, 52 weeks, it shows you the lowest point. I'm sorry, it shows you what it traded at a year ago till today. Oh, I'm not trying to go there. Okay, this is not bad, but this is okay. Let's try this. The last year to date, it shows you where it traded at. No, that's year to date. The last 1 year. It shows you where it was at a year ago, and it shows you where it is at now. Now imagine if you are a short-term trader and you bought it here and you sold it right here. Okay. You see what I mean by long-term, short-term traders? Yeah, you may have made money if you bought it here and sold it right here. You may have made maybe $100 an additional per share, but compared to right here, okay, this is nothing. So as a stocks appreciate over time, all things being equal, stocks appreciate over time. So that's just a brief overview of a chart. So the 52-week range is important. It gives me a good, good feeling of where the stock can and cannot go. So the volume tells us how much it was traded during the day, during the trading day of Friday. It means that there were a lot of, it didn't trade as high, but this is at 9 million. It was pretty active. It was averagely active. And in general, over time, the stock has an average volume of 14 million. So the reason why we look at volume is we want to know that when it comes time to sell this stock, are we going to find a market? Is there going to be a market for it? You don't want to buy a stock that the volume is maybe 100 per day or maybe 1,000 per day. That's really, really, really low. Okay. Now, another thing, just really quickly, remember I talked about the price earning ratio. This is where what it's going to look like, and they're going to give you the values, which is why I'm not really going to spend a lot of time analyzing that because they're going to give you the values. Earnings per share, that's a negative earnings per share. That's where that information is as well. If this particular stock paid a dividend, you would see it right here. I'm sorry, that's the ex-dividend date. If it paid a dividend, you would see it right here, dividend yield. Okay, so remember when I was talking about a stock being undervalued and overvalued? Look at this, okay? Tesla is currently overvalued. So if you're going to be buying Tesla right now, you're going to be buying it at a quite high, at its highest point. Because if you look at a max chart, and this is why charts are great, no matter it doesn't matter if you're technical or a fundamental, one way or another, you would need to learn how to look at charts. So look at this chart. It gives you a picture of what Tesla has done for the last 10 years. Okay. Yeah, this is 2010. 2010. Yeah, for the last 10 years. 10 years ago, it was at $19.94 per share. $19.94 per share. 10 years later, it is at 1,500 shares per share. Now, there are many, I'm not trying to, there are many things that you need to look at when it comes to Tesla, right? A company is more than just what you see on the charts, etc. There are other things like there are other fundamental news that you need to pay attention to. Tesla is heavily reliant on the delivery of its cars. Now, what happens if there is there's an issue in its process? Okay, what happens if they're not able to deliver on the goods and on their goods? Guess what? Investor sentiment will go down. Investor sentiment will become a little bit more negative, and you would see that this particular stock will drop. And you can see this drop happening right here. Okay, you can, in the last 6 months, you can see this drop happening right there. Okay, in the last 1 year, you can see this drop over here, and then you see a gap up right there. So that's when Tesla went from 354 all the way to 900 as of January the 20th, because of the news that came out about its cars that it sells. Okay, so I'm gonna pull up one stock, Nvidia. Nvidia. Another thing to take note of is this. Okay, where, let me see here where you see the sector. We're going to talk about this a little bit more. We're going to look at this more in depth, but just not right now. Okay, so I was just trying to show you, I do have another platform I use. It tells you the particular sector. It tells you the sector Tesla is in. Tesla, I guess, right? Automotive, energy generation, and storage. Okay. And I also use Google, you know. Google nowadays makes it quite quick to find anything you're looking for. So as an investor, please don't shy away from doing your research and looking at Google. Nvidia, NVDA, okay. Okay, we're looking at Nvidia. We're looking at, well, it's been all over the place. I tend to look at a 1 month, okay, to see what it's been doing the last month. I tend to look at a 6 months. It's not changing. Okay. Oh, it's not changing by much. It's because there's not been too many moves. Okay. I tend to look at a year to date, and I tend to look at a 1 year. Okay. The 1 year again is a 52-week range. A year ago it was at $147, and now it's at 431. It is currently overvalued. It doesn't necessarily mean that you cannot buy an overvalued holding. Okay, it just means that you have to be cognizant of, you have to have a good handle on when to enter. If something is overvalued, you want to spend more time now looking at its what is it, at its technical information. If something is already overvalued, it means that any upside that the stock can have in the long term or in the future has already been priced into its current price. So you want to take it a step further and also analyze it from a technical perspective and not just a fundamental perspective if something is overvalued. So American Airlines, just for the fun of it, I will pull it up. American Airlines Group, AAL, it's doing quite bad. So it is undervalued. It is part of the travel industry, aeronautics industry, travel industry, which means that it's been taking a hit. People have not been traveling. We see what happened. See, look at this. This is where it was January, right? Right before, right before the lockdown and the quarantine and traveling. So look, it went from there to whoosh all the way down here. It gapped up just a little bit, and right now it is currently downtrending. is currently downtrending. Now, what's gonna influence this to go back up? Well, look at here. In 2005 and 2009, you see same thing happened in 2005 to now is almost happening here. So the people who bought the stock right here did have a nice appreciation right here. And you can look, remember what I said about market cycles, right? Economic cycles. This is cyclical. So it goes up, okay, comes down, okay, it goes up, it comes down. So that's something to take note of. So that's where I'm going to end today. I'm not going to go too in depth with this for now. I think information we have thus far is just a good stopping point. It's a good stopping point. I am going to end with this. That way I don't over inundate you with information. So this is where I'm going to end. Any questions? Let me know. I'm going to pause for a second. Let me know if you have any questions. Okay. It looks like we don't have any questions for today. And I also have to keep into account that obviously the streaming, you guys tend to hear me. There's like a 10-second delay. So I just have to take note of that. Okay, so no questions, no questions, no questions. So hopefully we got all of that. If you haven't shared yet, please share. If you haven't invited, please invite. We are going to be getting more in depth with this. Now, I don't want to spend too much time talking about the stock market. I think I'm just going to cover a few more sessions. If you have further questions, sign up for the one-on-one session with me. That way we can get going together. If you have any topics you want me to talk about you haven't heard yet, if you have people who you think would be great to come on, just let me know. Oh, there's a question. Why do some trading platforms like Robinhood limit how much you can withdraw from your trading account? To be quite honest, that's those are some of the things that you have to research when you're looking at the best companies to trade with. You want to find a broker or a trading platform that makes it easy for you to withdraw money from your account. I cannot stress this enough. You want to find a trading platform that makes it extremely easy for you to withdraw money from your account. When you're not able to get all your money at any point in time from your account, let me just put it this way. When companies hold on to your money, there is a, how do I say this? There's a benefit. Let me just put it that way. There's a benefit to them when that is done. So one of the things that you want to pay attention to when you're looking for a broker is how easy is it to understand your platform? How easy is it for you to reach somebody if you have a question? How easy is it to remove your money? If you need to take your money out right away, you need to be able to do so quickly. If they go bankrupt, is it a reputable company that you can get your money out of? So just take note of that. Why does Robinhood do that? I couldn't tell you why. I don't know. But a lot of times when companies hold on to your money, it is because it serves a purpose to them. So pay attention to that. Okay, so it looks like we're gonna end here for today. I'm trying to keep these things under an hour long. It's not too long. If you have any questions, see me. If not, I will see you next week at the same time talking about part 2 of investing in the market. And next week, I'm going to go do a little bit more of what I did towards the end, show you what to look at, how to place a trade, all of that. Then after that, if I have a little bit of time, we're going to go more into the technical side of investing. So without further ado, again, I'm Phoebe. My name is Phoebe with the Frugal Thieves platform. If you haven't yet, please subscribe to our channel. And last but not least, all the information I provide on this segment is only for educational purposes only, no personal recommendations. If you need me to do anything for you, reach out to me one-on-one via Facebook, via frugalfeebs@gmail.com. You can email me. You can call me if you have my personal information, but preferably the best way to reach out to me is via email, via Facebook messaging on the Frugal Phoebes platform. Thank you for joining once again. It was great hanging out with you guys, and have a blessed weekend. Goodbye.